Hi, everybody. I'm Cindy Coggins with Cindy Coggins Realty Group, Keller Williams Allen, and we're here this evening with Tommy Tynes from First Bank in Frisco. We're going to be talking about the mortgage industry. Hey, Tommy, how are you doing this evening?
Doing fantastic. How are you?
I'm wonderful. Thank you for asking.
Good.
So let's just dive right in. Everybody has been asking me what's going on in the real estate industry. How's this affecting loans? So, from your point of view, what is going on in the mortgage industry today?
That seems to be the best question that we've had each and every day because it's constantly changing. We've seen a lot of things just over the last 60 days that have happened in our industry that we never fathomed would ever happen. For example, we saw the bottom fall out of the market right before the shutdown, which created a huge rush of refinances into the industry. That then went and sent the servicers and the investors into a very anxious position because when you have an influx of refinances all of a sudden, it takes away a lot of the liquidity that the mortgage servicers are used to having in their back pocket. Because what a lot of people don't understand is when a homeowner doesn't make their payment, the servicer still has to make their payment to the investor, whether they received a payment from the homeowner or not. So when a lot of the liquidity goes out of the marketplace from the refinance rush, and then as more news was surfacing over the shutdown, lack of employment, lack of funds coming in every month for homeowners, that's then when servicers turned around and started getting even more nervous over what was coming, impending forbearances, default payments, foreclosures, and short sales are going to become common again in a lot of different marketplaces because of everything that we have gone through and what we're currently going through right now. So we're seeing a lot of dynamic changes. With that nervousness comes a lot of changes as far as the loan products that we can offer from a day-to-day standpoint. What we've seen over the last several weeks are the non-QM loans, the loans that are not backed by Fannie and Freddie. Those went away immediately. Those were way too high risk. And we're talking about your asset depletion loans, your stated income loans, no tax return document type loans, the really unique things that are outside the Fannie Freddie box. Those went away first.
Right.
Then we saw a real tightening of credit risks in our loan products. For example, right off the bat, the industry came out and said, okay, no more government loans below 680 to 660 credit scores.
Right.
So USDA, VA, and FHA essentially pushed a lot of people that were currently in the market to buy or refinance. It pushed them out of the market altogether just overnight.
Yes.
What we've seen recently is the disappearance of jumbo loans. We saw Chase and Wells Fargo exit the marketplace pretty quickly, one right after another, and it minimized the amount of jumbo loan investors that we can then turn around and sell these loans to, which handcuffs us on the back end. And so we're really experiencing dynamic differences every single day in our industry just because of the fear of everything that is upon us and those things that we can't even tell that will fall into place here in the next 60, 90 to 120 days.
Wow. It really has affected it. And we're seeing that as well on the real estate side. So folks that we had under contract that were maybe FHA that were sitting at a 610 with down payment assistance, all of a sudden they weren't qualifying anymore. And they actually had lost out on that opportunity. So it really affected a lot of people, and it's been very hard. And with that said, I would like to ask you, what about those folks that can't pay their current mortgage payment?
Yeah.
What should we be looking at? What do we need to tell folks out there regarding that?
So that's a great question. And it's a question that comes up quite frequently when there's craziness in the marketplace, and we're not sure from one homeowner to the next, what's going to happen. How are they going to be able to pay their mortgages? Do they have enough in savings to be able to weather the storm? I put out a statistic that I saw this morning that in 2018, the Federal Reserve took a poll, and only about 40% of Americans today would be able to weather the storm for 3 months based on what they have in their savings. And that means that there's up to 60% of Americans right now that are living paycheck to paycheck just to be able to afford their lifestyle. So with that being said, when all this happened, when the shutdown happened, the government wasn't prepared. FHFA, who is the governing body over the government loans and things like that, they came out and said, yes, we're absolutely going to support our loan servicers and investors in offering forbearance for those who've been out of work, which will then just defer those payments further on down the road. But they didn't give a whole lot of instruction as to what that would look like.
Right.
Bigger piece is the credit piece. What is that going to do to you on the credit side? Well, let's say that if I'm a homeowner and I can't make my payments and I enter into forbearance, then yes, they're going to adjust the loan terms and push those payments further down the line. But the loan servicers still have to report to the three credit bureaus every single month as to whether you made your payment, it was late, 30, 60, 90 days, things like that. We still don't have a very clear-cut answer from the FHFA as to how they're going to have servicers approach these situations. And then there's another guideline that a lot of people weren't very familiar with, especially outside of the mortgage industry, that there are regulations in place right now that state that if you have a current loan and you have deferred payments at any point in that loan, that you cannot finance that loan at any point in time. So that means that people who were in a bind, who took advantage of the forbearance, are going to be handcuffed long-term until they figure out another route, another alternative way to help offset some of these financial pains that we're going through as a country, and as a country that really made a strong push to give everybody the opportunity for homeownership. Well, now we're going to see the reverse side of that.
Yeah, it's tough for a lot of folks, and we are seeing it every day, and our empathy goes out to those folks, and we just want to be able to support them as much as we can and give them great information that you're providing. I think is one of the key things is education, and knowledge is power, and knowing where you stand makes a huge difference. And we want to make sure that we get as much information out to folks that we can with good quality folks like you. So I do have.
Let me add on to that real quick.
Sure.
And I want to make sure that this is said, because this unfortunately, because of all this, there are some negative connotations coming out in the marketplace as far as what to do next. People who have lost their jobs, who don't have the income coming in. If you need forbearance, you need to take advantage of forbearance. Do not feel bad if you have to enter into forbearance with these loan servicers, because that's what it's there for. We will help you figure out an alternative route once this all falls out. And the good and the bad. The government hasn't figured out how to handle this just yet. Not every servicer is on the same page with how they're going to approach this, and that's okay. But if you need to enter into forbearance, if you've lost your jobs, if you don't have the kind of income to pay these bills, take advantage of the forbearance. We will help you figure this out after the fact. You're not going to be stuck in a hole that you can never get out of. We will help you figure this out somehow, some way. It just may not be as easy or simple as a straight rate and term refinance or anything conventional that we see right now anyways.
Well, and I think it's better, Tommy, to take the forbearance than just not make the payment. You cannot just not make the payment. You need to contact your mortgage servicer. You need to have those hard conversations. it does leave a bad taste in your mouth, but we need to make sure that we address our problems, because our problems aren't going to go away just because we ignore them, or are fearful or just don't know. It's always easier pick up that phone, have a conversation, and listen to the trusted advisors.
Well, and there are too many of us who are going to go through this for the government just to turn their back on us, right?
Yeah,
It's the
exactly.
same government that encouraged equal housing opportunities. Well, knowing that there's a significant portion of the marketplace that's going to have some kind of alteration in their loan repayment, they will figure something out. Will it be tomorrow? Probably not. As we know that our government operates kind of at their own time frame, something will be figured out. We just don't know when, how, where, what it's going to look like just yet, but we will start to see that unravel here pretty soon. I'm pretty sure of that.
Very good. Well, I've had a question that's been posed to me from some of my buyers, and that is, do we need pre-approval? Are we needing pre-approval or pre-qualification? What do you want to do and speak about that for us?
I think where we stand from a First Bank perspective, from me and my team, we want to go ahead and get the client pre-approved. That's not always going to be the case. It really depends on what's the client's comfort level with this process. Are they just kicking the tires? Are they really invested in going through this process? If they are, we are going to encourage them to go ahead and send us their documents. Let's process the application. Let's pull credit. Once we have everything together, let's go ahead and submit the file into underwriting and get that upfront approval, or have a better understanding of all the hurdles we need to navigate past in order to get the client to the closing table. So for me, I really do appreciate the opportunity to go ahead and get that pre-approval. Really, logistically, it helps to eliminate a significant amount of time from the transaction process, so that really, once the client's pre-approved, once you help them get under contract, at that point, we're disclosing the loan, we're ordering appraisal, ordering title, we're tightening up on those final conditions that we need from underwriting, so that once we do have the title and appraisal, we can submit everything back into underwriting and get that clear to close pretty quick. Sometimes we're talking about 2 to 3 weeks worth of the process eliminated up front just by having that pre-approval. But then the other end of that, when you're out helping your buyers, figure out which house they want to negotiate on, and most of the time, buyers are going to typically be attracted to the same houses. If for whatever reason they get into a multiple offer situation, this does give them a better opportunity of strengthening their offer, knowing that they already have a loan approval standing behind that offer, rather than another offer coming in where they've only been pre-qualified. Maybe there are a few holes that need to be filled, a few questions that need to be answered, that could still take 3 to 4 weeks in that process.
I agree. And there is a difference between pre-qualification and pre-approval. And I always suggest to my clients to get pre-approval because, one, it does save time. We are more qualified at this point. We know where we stand financially. I always tell them, it allows me to know how much we can spend and when we can spend it. And Tommy is the one that's going to tell us that. So pre-qualification, if you would quickly explain to the viewers what a pre-qualification is versus a pre-approval.
So a pre-qualification is just as simple as receiving a full application from the client and being able to pull their credit to make sure that, based on the scenarios that are presented in the application, things check out. Number one, that they have a good credit score, qualifiable for whatever loan product we're looking at. Number two, that they don't have any issues in their credit history, so that we can ensure that this is not just a qualifiable borrower by credit score, but also by credit history. And then it also gives us a better understanding of where that client sits as far as loan to value with the down payment differences in each particular scenario, but also debt to income ratio, which is very, very critical in ensuring that not only do they qualify for the loan, but also that this purchase price and that monthly payment are affordable in their monthly budget. And so a pre-qual just really is a good application and allowing us to pull credit to check off, certain boxes within, the initial approach. But then a pre-approval is taking that next step in getting all the loan documents along with the application and the credit report, submitting that into underwriting. The scenario is considered a to be determined scenario because we don't have a property identified just yet, but we do have certain aspects where we can estimate taxes, insurance, mortgage insurance, monthly mortgage insurance cost associated, HOA dues, things like that. Submit that to the underwriter, let them do a high level initial review, give us that loan approval based on certain conditions. Once we realize that those conditions are easily overcome, especially based on that person's credit profile, then we have confidence of sending them out into the marketplace, looking at different opportunities and supporting them when they find the right situation for themselves and making as strong an offer as possible.
Very good. And I think that's important, not just for buyers to know, but sellers to know the difference. So when they receive an offer, if they have a pre-qualification versus a pre-approval, we know that that pre-approval has gone a step above and beyond, and we can be a little more assured that the qualification for the loan on the home that they are choosing to purchase is a little bit closer. We're just a step ahead of in the game. So I think that's really, really important for sellers to know too, especially in these changing times.
And you know that as a listing agent, every time you see an offer come in with a pre-qual letter, doing your diligence on your client's behalf, when you reach out to that lender and that lender says, hey, Cindy, not only are my clients extremely qualified, but we already have a loan approval. We already know every question that we need to answer per the underwriter's conditions. We are well equipped and ready to move fast to get everybody to the closing table. That just gives the listing agent more confidence to go back to their sellers and say, look, we've got some really good offers here. There are a lot of parties who are interested in your property. They're all willing to pay a good price for this, but we have at least one or two of these offers that really stands out because they've gone the extra step. They have the loan approval, and we know that without much hassle at all, we're most likely going to get to the closing table on time, if not ahead of time.
I think that just hits the nail on the head for me, and that's one reason that I have my clients and always suggest to them to go ahead with that pre-approval process. So another question that has been posed, and I think a lot of people have had questions about different loan products and qualifications for those products. So what are some of the different types of loans and qualifying for those?
So, like we said early on in this presentation, there's a lot of things changing. So what I'll speak from is a more general approach rather than what we're experiencing right now. You typically have your four major loan products. You have your conventional, your FHA, USDA, and VA. The two major ones are going to be your conventional and FHA. And it's going to be based on the borrower's credit scores, credit history, debt to income ratio. There are a lot of different factors that will determine which way we go, based on the client's particular situation. So with an FHA loan, it's a government-backed loan. FHA, USDA, and VA are all government-backed loans. They all come with what's called an upfront funding fee. VA, if you have enough disability through the VA, you can avoid the upfront funding fee. But at least with USDA and FHA, you've got that upfront funding fee. It's a certain percentage of the loan amount that's rolled back into the principal balance. And that's part of their guarantee that if for whatever reason the client defaults, they'll at least have a policy in place to be able to get some of their money back and further support the loan servicers, in their venture to get this loan paid off. Okay. So you've got the conventional and the FHA. FHA is a great product when we're talking about lower credit scores, higher debt to income ratio. But really, like we talked about, it's got the upfront funding fee. And the biggest deterrent that I find in dealing with my clients is the fact that FHA right now, it hasn't always been this way, but it has for several years now. Right now, you can never get out of that mortgage insurance payment, no matter what kind of equity you have in your house, as long as you're in an FHA loan. So a lot of the conversations I have with my clients who enter into a purchase through an FHA loan, if we know they're going to be there long-term, the FHA loan is not the long-term vehicle for them. We will absolutely look to refinance them out of that product into a conventional loan down the road, if not to get them into a better rate, certainly to get them out of that mortgage insurance, especially when we know we can prove that they've got 20% equity in the property, because in a conventional loan, that's when that is released. Okay.
Very good.
So we've got the FHA and the conventional loans. Conventional loans don't have the upfront mortgage insurance. Depending on the client's credit profile, could be a little bit higher rate than what's being offered in an FHA, but that's okay because it still offers you that freedom to get out of mortgage insurance once you can prove 20% equity in your home. So there are some pros and cons either way. And like I said, there's so many different scenarios that each individual borrower brings to the table that determines which way we go in loan product, just based off of really particular details about that person. So I'm never going to approach a buyer and say, well, you're a 640 credit score, so you're definitely FHA.
Right.
Well, it's going to depend on down payments, monthly payment, necessities, interest rates. There's so many other factors that play into how we go about this. So really what's critical is the education piece up front, so that we're showing the different scenarios to the client, providing them with fee worksheets on both sides, and then talking through the details with them so that they can make the best decision possible. Not me. My job is to support them whichever way they decide. So those are the two major players. The USDA and the VA are the other, big loan products. USDA is more for the outlying areas. Right now in the North Texas, North Collin County areas, once you get north of Anna Melissa, everything from Van Alstyne up to Sherman, up to the Red River, that's all considered USDA areas. Outside of Princeton, outside of Denton, those are all considered USDA areas. And that allows you to come to the table without a down payment. So therefore, again, allowing for a little more affordable approach to buying and getting into the house. But there is an upfront funding fee that's a part of this. And if you want to stay away from extra cost rolled into the loan, you might want to consider something other than the USDA if you can also afford a down payment.
Now, sorry about that, Tommy. Sorry to interrupt. What about the interest payments on a USDA? Are we seeing those? Are they typically more than an FHA? Are they same? Explain to viewers about that.
The interest rates are pretty similar to FHA with USDA. So there is some attraction there, and there are some more critical qualifiers to be able to be eligible for a USDA. For example, I had clients a couple of months ago who found a house in Tom Bean, as a matter of fact. They really wanted to buy this house through the USDA loan to avoid the down payment, necessity, but at the same time, they also qualified for a conventional loan. That's when the underwriter came back and said, no, we can't qualify them for a USDA. They also qualify for a conventional loan. We need to look at other loan products. Fair enough. USDA is there for a specific reason, and it's certainly not there for people who are of high enough qualifications through credit, income, and asset positions just to simply avoid a down payment. That's not really what it's for. It's for those who need that product and benefit because there is no down payment there.
Okay, very good.
And then the VA, the final product for those who have served our country and have VA eligibility, is a fantastic opportunity for them to get into a home as cheaply as possible, where they do have the upfront funding fee, but they don't have to bring a down payment, and they don't have mortgage insurance as well. There is, like we said, the upfront funding fee. The good news is if a person has enough disability through their VA eligibility, that can help offset that upfront funding fee or eliminate it altogether.
Okay, very good. So I am going to roll on a little bit away from that to our FICO scores and how it's affecting our rates. We have noticed that some of the investors that purchase loans are telling folks that it's going to have to be a 680 or above, or a 660 or above, even though the FHA requirements may not dictate that. The people who are buying the loans are saying, we are going to dictate. on FHA or conventional or different things. So how does my FICO score affect the rate?
So it, just like you described, it's now a determining factor as to whether you even qualify to buy a house now or not, whether it typically conforms with FHA, conventional USDA type products. That is really what they did, where they locked down on the inherent risk. And so what we were really looking at is the fact that when all this risk was much more apparent in the marketplace, the investors really did tighten their parameters, their lending
You're going to
guidelines.
have to give that baby some loving, Tommy.
There you go. Sorry.
Hey, this is just part of the time that we are living in right now. And you know, these fur babies, they mean so much to us right now. But anyhow, go ahead back to the FICO score and how it affects the rate.
So what we saw was anytime you lend money to a borrower, there's inherent risk. And the servicer's job is to figure out what that risk looks like per these different factors, per the individual's credit scores, credit history, monthly income. Consistency of employment is also one of the biggest things that's really affecting us now and will going forward, knowing that as a society, we are susceptible to viruses and shutdowns at any point going forward. So these are the factors that are coming to the table. But what the industry basically did several weeks ago is they said, hey, look, obviously, in order to get into an FHA loan, we would love for you to be at least at a 620 or above. There are FHA products that go down into the low 500s, now. But traditional FHA products started at 620 and went up from there. Now, FHFA and a lot of the servicers came in and said, okay, so because there's too much risk for credit borrowers between 620 to 640, maybe even 640 to 680, that's when they came in and said, okay, we're no longer going to allow lending to government loan applicants below a 680 credit score. The caveat that I'll throw in is, in the ironic piece of this, are the TSHAC, SETH, and other down payment assistance programs were holding steady at, okay, if you had a minimum credit score of 660 or above, or 640 and above, you could still qualify for these products, receive the down payment assistance, and close on your new home, even though you didn't qualify for a conforming conventional FHA, USD, or VA loan because of your credit score. So the FICO is absolutely critical at this point. And so going back to all my clients that I was working with up until the shutdown, that we were looking at lower 600 credit scores, FHA products, leveraging a down payment assistance program, we're now working with them to help get their FICOs up so that they can then qualify for a higher level of lending because they didn't otherwise qualify before. So we are doing a lot of management of credit repair, credit manipulation, debt elimination, things like that to help get these borrowers who were once qualified back into a qualifiable position because that matrix and that bar has moved.
Absolutely. Absolutely. And one thing that I have always done as a real estate agent, I've always interviewed my clients to find out the difference of their lifestyles. They may look the same on paper in black and white, but one cooks at home every night. The other one goes out to eat. One goes and makes a pot of coffee every morning, and the other goes to Starbucks. Those are very, very interesting questions, I know, to interview your client with, but I need to know what their lifestyle is because I don't want them to have to give up their lifestyle to be house poor. And I don't want them to have to give up, if the kids are in dance or in sports or these things, we don't want them to end up either A, filing bankruptcy or being in foreclosure or having to do a short sale. And I think along with that FICO score, if they are having to qualify at a higher rate, they're going to be in a better position to be able to continue with that loan, because they won't be in the mess that we had seen back in 2008 through 11, especially. It was very tough times. Short sales had skyrocketed. Foreclosures were all over the map, and it was very hard. And I think that is probably one reason that they have made these changes recently. And I think it will protect people in the long run from them own selves, if you would.
Well, and that's a great point. And just to kind of speak on that, it doesn't matter what environment we're in.
Mm-hmm.
Almost every single conversation that I have, the initial conversation that I have with a potential borrower and a potential client, is really focused on affordability. Affordability, because of everything that we went through from 2007 to 2009, even into 2010, and the changes that came from it, so much emphasis was put on the credit score, so much emphasis was put on the debt to income ratio. And that's what really determined affordability, at least from an automated standpoint,
Mm-hmm.
so that we could then move forward with a higher level of understanding for qualifications and underwriting guidelines to be able to get these clients through the process and get them into their new homes with a lot less hassle. But inevitably, there are always going to be clients who qualify for much more than what they can afford. Like you said, whether it's the extracurricular activities, how much money they want to put into savings every single month that comes out of their paycheck, how they live their lives. We need to do a significant amount of effort in getting to know our clients, understanding their lifestyle, their budgetary needs, because too many times in the past did loan officers qualify potential homeowners for a certain price, tell them absolutely go out and get that without ever paying attention to how that monthly payment fits into their budgetary needs. And most of the time, it didn't take long before those new homeowners realized we bit off more than we can chew. We were not advised correctly. We were not informed the right way. We had no clue what we were entering into, which is far more critical for first-time home buyers
Mm-hmm.
than it is for seasoned homeowners who have done this a time or two. Because first-time home buyers, when we go through the lending process, that's unemotional. And another reason why we do it so far ahead of ever assisting them in finding the right house, it's unemotional. Clear heads prevail when we're talking money, and they're guarded about their finances. But the minute they start walking through those front doors with you is when things get serious and emotions start to escalate. And we don't want that when we're trying to figure out what's affordable. So a lot of what we do on the front end is discovering how they live their lives. Bank statements can only show us so much. We can't see everything through somebody's bank statement. So we need to get to know the client. We need to know how they live their lives, what their monthly budgetary expectations are. And that first question is, what do you feel is affordable each and every month when you make that payment on the first and feel good about what you just did?
Yeah, I agree.
Are you going to allow yourself and your family enough room to go out and do family activities, to buy groceries, to pay your bills, to keep the lights on? Is that going to be enough for you? And if we do that, we'll have success just about every single time. And I always tell my clients, I don't care about the transaction value. I really don't. What matters at the end of the day is when you walk away from the closing table that you know you found the best possible house with the perfect loan in the best possible payment scenario starting off, because that will change.
Yeah.
And then we're good. We know that we've succeeded from there. We can't control what happens to the tax values after. We can't control what happens to their insurance policy after.
No.
But we can control what we know to be true from the get-go and from the day that they walk away from the closing table.
And in your life, I am, Tommy, we care about our clients. We care about their lives and their futures. We follow them for many, many years after they're going to be our clients. And we always want them to return if they have questions, if they need anything, to reach out to us and to know that we are those trusted advisors that are always going to keep their best interests at our, at the forefront and in our hearts. So with that said, once that we have decided, we've got the pre-approval, we found the house, but we're needing just a little bit of help with down payment assistance. Right now, can folks get down payment assistance on a loan?
Yeah, absolutely. And like I said, the irony is a lot of times we see people who won't qualify for a traditional type FHA loan, but will still qualify based on the new standards, but will still qualify for that loan through down payment assistance.
Okay.
And so, we did see a little bit of tightening, and we continue to see a little bit of tightening for what is permissible through these TSHAC, Seth, you name it, down payment assistance programs that are out there. We have seen the tightening of the credit requirements, but it's not so much now that they can't leverage that opportunity as well. So we are seeing it. It is making a lot more sense. We are seeing that the interest rates that are being offered through these down payment assistance programs are a lot closer attached to the market rate today than they have been in many years. And there were times when I would present both sides of the fence to my client to say, look, if you have enough money for a down payment and closing costs, we may want to avoid the down payment assistance program because the rate difference was so far apart, it didn't make sense. And that's a long-term implication by getting into a higher rate only for a short-term need, which is more money, more assets to take to the closing table. But now we're seeing a much closer connection between the market rates that are being offered for FHA, USDA conventional loans versus what's being offered in these down payment assistance programs, that you're not really giving up a whole lot. You may give up an eighth to a quarter of a point difference by taking a down payment assistance interest rate versus the traditional rate that's in the marketplace. But again, that's a lot closer in connection and a much better conversation than if the starting point is a half point difference between the two.
Right,
maybe
right.
further.
Very good, very good. Well, it's good to know that we still have options out there. Even though we're in unprecedented times right now, there are options. There are many loan products that are out there that we can try and fit them in. We have alternatives.
Right.
And I think it's very important, kind of going back to what you had said earlier, more now than ever, you're helping people repair credit and get where they need to be. And I think that really builds those relationships because you're down in the trenches with them, trying to help build them back up. And it is so important right now that we are helping folks do that. So,
and you know this as well as anybody else. We're salespeople, right? We sell, but we don't sell to sell homes or to sell mortgages or sell trinkets. We sell because that's a critical avenue to build relationships.
It is.
And like you said, when we help somebody get into a home, it's not about standing up from the closing table, giving them a big hug, saying, thanks so much, all the best. It's about, and I usually tell my clients, that's where the relationship starts.
Right.
Because we're still going to be there to make sure that they file their homestead exemptions come January 1st of the next year. We're still going to be there when they have an issue with their escrow account. We're still going to be there when their tax values, which just came out, when those come out, they're going to turn to us.
And we do CMAs for things like that. And I do it for free for our clients, to try and help them protest taxes and different things. It is a lifetime relationship with folks. Even I have folks that call me and say, hey, Cindy, do you got a good plumber on your list, on your vendor list? Do you have an electrician? Who do I call? And I want to be that advisor that they go to, for things like that. But very interesting. So one more huge question that I'm going to ask you. What is the best way to secure our mortgage rates right now?
So the biggest deal is just like we've talked about, get pre-qualified, get approved as quickly as you determine you're ready to move. Okay. That is going to be the most critical piece. Once you know what you're dealing with, once you have a real good feel for everything that it's going to take to get you to the closing table, you're in a good position to go and buy. Unfortunately, we just can't lock a rate until you are under contract. So if you're ready to go, if you want to take advantage of today's rates, I strongly encourage people to get qualified, get ready to buy, get everything in place so that they can get out there and start looking at these homes. We're at the front end of buying season. We're going to see things really start to heat up. We've already seen them start to heat up, fortunately, in our marketplace here over the last week and a half, couple of weeks. But being prepared is truly the essence of being able to take advantage of opportunities that are in front of you so that you can then, once you're under contract, turn around and get locked into an interest rate. Doesn't mean that we're going to necessarily lock you into an interest rate right then and there. Just like we've seen over the last couple of days, rates have increased a little bit. I think they're in preparation for some more bad news that we'll see by the end of the week. We've seen that kind of trend over the last several weeks. Rates will jump up Monday, Tuesday, Wednesday, and then kind of settle back down Thursday, Friday, based on the unemployment numbers that are coming out, based on, a lot of this critical data that's coming out. But at least you're prepared to be able to jump in and lock an interest rate as soon as you're under contract and the right opportunity presents itself in the marketplace.
Well, and rates are historically low right now. Right. Even though we may see some fluctuation during the beginning to the end of the week, right now they are definitely at some of the historical lows we've ever seen. And that is a prime time for our buyers to take advantage, if they are in a position to do so, to go ahead, get pre-approved, and let's get them in a home while the rates are low. So now, if somebody is not planning on moving and they are going to stay in their current home, what should they do? Should they look at refinancing, and at what point should they refinance as far as their interest rate? What does that look like? What are your opinions on that?
So we are talking right now, we are having conversations with anybody that's in a 4% interest rate or higher. There is certainly good opportunity and good value available in the marketplace. And then from there, we really start to extend that conversation of, okay, are we really just looking at a simple rate and term refinance that will help minimize their monthly payment by, obtaining a much lower interest rate, maybe even helping them, establish that 20% equity to further get them out of the mortgage insurance payment as well. But certainly, we're having conversations with people who are in the high 3s, low 4s at a minimum, because there's still good value out there in the marketplace.
Right.
But then let's look at the bigger picture. Are you in some high interest credit cards that we could roll back into the equity that you've accrued in this house? Are you looking to do some home improvement projects? What we've seen, in many different facets of the real estate industry, especially in the contracting side of things, is that with everybody being at home over the last several weeks, it's caused a lot of people to piddle, a lot of projects to surface, or that to-do list that they've been putting off has now come front and center. And so now we're seeing a lot of people say, okay, you know what? I've got some pretty good equity in this house. Maybe now is the time to get the funds we need for this project, or leverage the equity for this issue, or go ahead and pay off that debt. Whatever that looks like, there are so many different avenues that we can look at and consider by refinancing, especially if you're in a higher interest rate than what's available out there in the marketplace today.
Very good. I am going to kind of turn from that area, whether you're refining or whether you are purchasing a new home or a pre-owned home. How has COVID affected the closing? Is it causing any delays in our closing that you have seen?
We haven't really seen delays because we are extremely fortunate here in this marketplace that this has been a very strong real estate market. And when you have strong real estate markets, you have high expectations, high standards, but also a demand for high performance. we are very fortunate to work with at First Bank. We have some of the best back office staff I think that you could ever wish for. I have closers that I've seen in recent weeks work all hours of the night and morning,
Yes.
never stopping, to make sure that these files continue to flow seamlessly. But I've also seen that on the title side as well. Title has probably the most difficult job of appeasing all parties in the transaction. That includes buyers, sellers, and lenders, appeasing both clients when everything is finished. Now it's time to put a bow on the transaction, but now we can't go through the traditional steps of sitting at a closing table, exchanging documents, being close to each other, things like that. So they've had to navigate through a lot of uncertainty in these past several weeks by having drive-up closings where they'll hand you the documents, through your car window so that you can sign them, in a clean environment with minimal exposure to other people, other foreign substances, other objects, things like that. We've seen them really become creative and unique in their own individual rights, but nonetheless, they've gotten the job done. And I don't think that there's enough credit being given out there to those who are behind the scenes or with the title companies that have made these transactions complete.
They really have. They really, really have. It's been amazing how they have really stepped up their game and what they're doing. And it's so appreciated. And they're helping take care of our clients.
Right.
It's just, we are so grateful to them.
This isn't easy. This isn't easy for anybody, but they are having to navigate through uncharted waters in a manner to appease everybody.
Yes.
For me, as long as my realtor is happy and as long as my buyers are happy, great. I'm going to do the very best I can for everybody else in the transaction, but I have distinct responsibilities to two sincere parties in this transaction. And there are so many other people that are involved in the transaction that title companies really have to keep.
Absolutely. They're trying to keep two realtors, a lender, the buyer, the seller. Everybody's got to be happy. And they do have a lot of weight on their shoulders. That is absolutely correct, Tommy. Well, I tell you, it has been such a pleasure to be able to chat with you. And hopefully we have brought some value to people that are listening and viewing. We hope that if you have questions, please reach out to me or to Tommy. Tommy, let the viewers know what the best way to contact you is.
So the best way to contact me is always going to be through my cell phone. I'm always available. And that number is 469-951-2229. As I said, that is the best way to get in touch with me and, where I'm most available via call or text.
Okay. And again, I am Cindy Coggins with Cindy Coggins Realty Group, and you can reach me at 469-499-7452. Tommy, it was great to have you on. You have a blessed evening. And guys, we'll see you soon.
Thank you so much.
Thanks, Tommy. Good night.
Good night.